And every time you see the Bank of China, the People's Bank of China, buying gold, just think it through. They're not buying gold, they're selling dollars. I mean, they're getting out of fiat. They may say, I can't afford to pay $4,000. I can't afford to pay $5,000 for gold, but I can afford to pay $60 for silver. Foreign ownership is in excess of $16 trillion. What are they going to do? When markets turn turtle, you don't sell your own stock, you sell foreign stuff.
Okay, ladies and gentlemen, so today we have Alasdair Macleod on our show for the first time. And today we will look at the US economy, commodity sector, precious metals, of course, and many other very interesting topics. So, sir, thank you so much for being here.
That's my pleasure.
Thank you very much. So, very busy times for the precious metals analysts, of course, and in the overall economy. So, I would like to start with the big macro picture. So, what's your take on what's happened with the US economy and what would be some of the things that you are paying attention to right now?
Well, I think the US economy is weaker than most people think. There are two reasons for this, there are two symptoms, if you like, of it. The first is that if you take out the government deficit out of GDP, you can see that private sector GDP, in fact, is contracting nominally, and that's quite severe. And the second thing is that even though we've got the shutdown of many US government statistics, particularly unemployment statistics, other statistics which come through indicate a softening in the economy. So it is softening. And basically, what this means is that the Fed is changing its priority from controlling inflation to trying to stop unemployment rising. And I think a lot of that is why the gold price has been rising in recent months.
Right. And this possible slowdown in the US economy, what would that mean for the stock market, which by a lot of metrics already is extremely overvalued?
Well, I think the point that one has to understand about stocks is that they're driven by the expansion of bank credit. Bank credit has been aimed at financing financial assets. It's as simple as that. This matters a lot more than any fundamentals. It means that people who sort of can drive their investment philosophy by sort of a momentum approach, they get the financing out of the banks in order to do it. And if you look at the margin finance statistics, you can see that these are produced by FINRA, the regulator. They're currently running at a very, very high record. I mean, we're looking at over $1.1 trillion. Now, the point is that that finances stock positions of three times that. So we're looking between $3 and $4 trillion worth of stock is on margin. And as situations change, you can see that that is a credit bubble which is bound to burst. And this credit bubble is the biggest we have seen in history.
Hmm. And so if we look at the big picture, on one side we have stock market that it's very overvalued by a lot of metrics. We also have the debt levels in US that are really, really high. But then on the other side, we have monetary system where the government will do absolutely everything they can to avoid deflation. So what do you see happening between these two forces in the next few years?
Well, it's important to understand that debt and credit are basically two sides of the same thing. For every debt, there is a credit. And indeed, it's the expansion of debt which gives value and wealth because, put simply, if let us say the government borrows money, and you as an individual buy government stock, if the value of that stock rises, which it should rise to par if it's been issued at a discount, or if interest rates tend to fall, then you could expect the value of that government stock to rise. That is wealth, and it's all part of the calculation of your net wealth. So the expansion of debt is not necessarily a bad thing. It's when it gets out of control that it's a bad thing, and that roughly is where we are today. As to what government are doing, yes, they are expanding debt even more, their debt. Um, Because, I mean, if you look particularly at President Trump, I mean, he's a spendthrift. I mean, and he's put huge, great political pressure on the Fed to reduce interest rates. And, the Fed is crumbling under that. So, yeah, I mean, you're going to see increased deficits. And not only that, but if the current signs are right, and that is that the US economy is going into recession, slump, whatever you like to describe it, then a welfare-driven state such as America's is going to face lower tax revenue, higher welfare costs, in other words, a higher budget deficit.
And that's not good for the US dollar for the long term, right?
No, that's correct. It's not good because it's got to the point where it's unstable. And I mean, bearing in mind that the dollar is a fiat currency and has been now for 54 years, um, all fiat currencies eventually fail. And I think the risk is that we're now in the end game as far as the fiat currency system is concerned. And if that is the case, then the dollar is likely to lose all its value unless it becomes tied again to gold.
Mhm. And with the slower economy and interest rates going down, well, at least that's what the government wants to do. Would you be interested in the bond market?
No, for the very simple reason that there's a difference between interest rates and bond yields. Interest rates are very much the short end of the yield curve, overnight money, if you like, or treasury bills, with sort of 3 months or 6 months or up to a year to run. That's a very, very different thing from term lending out along the yield curve, 10-year or the long bond at 30 years. They reflect the risk that investors would see of a deterioration in the purchasing power of the currency. Because if you're going to buy, say, a 10-year US Treasury, not only do you part with the money so you can't use it for something else, not only do you have to make a risk assessment of the US government, but you also have to think in terms of what that dollar that you've invested is going to buy in 10 years' time. So, that all that translates into an interest rate, which you would expect to get expressed, if you like, as a bond yield. And so if the outlook for the dollar is deteriorating, then obviously the bond yield will have to rise. And that's the situation we're in broadly at the moment. I mean, for the last 2 years or so, bond yields have just marked time. After an initial surge, they've just moved sideways. But I would fully expect them to break out on the upside and go considerably higher. And we've got precedent for this. I mean, we saw this in Britain in the 1970s, 1975, 76. Inflation in 75 ran at 25%. By 1976, it declined to about 17%. But the UK government got into trouble financially and had to call in the IMF for a loan of $3.9 billion. And I can remember at the time long gilts being issued with coupons of 15% and more. Now, think what that would do to the US government's finances. That is in prospect, and I can't see any reason why it would stop at 15%.
Just a very quick break, guys. So I've spent the last 12 months creating this course, Wealth Building Blueprint. I've put an unbelievable amount of effort into it. I cover investing, trading, speculating, business. The course is perfect for people who are still relatively new to this wealth building process. And I also offer 3 days money back guarantee. No questions asked. If there's absolutely anything that you're not happy with, you will get your money back. There's also a private community where you can ask me any questions, you can talk between each other, you can share news and things like that. The link will be in the description. Right now the course is at a 70% discount, and let's continue with the video. And with the current debt levels, that would be a huge, huge deal. And so Alasdair, I would like to move to the precious metals sector. So gold has performed quite well recently. And if we look at the macro factors that got gold to these levels, I suppose they're still here. But at the current price, what is your take at the gold on the gold market?
I think the way to look at the gold price is that over long periods of time, the value of gold, expressed in goods, if you like, or in other commodities, is very, very stable. I mean, this is why it is money. This is why it is the ultimate settlement, as it were, without counterparty risk. So if you bear that in mind, and you then see the price of gold in dollars rise from, I mean, in 2016 it was $1,050, and today it's $4,200, $4,100. You would think that the gold price has risen. No, it has not. There's obviously some volatility from the gold side in that, but more than that, it reflects a fall in the purchasing power of the dollar expressed in gold. And once you understand that, you understand really what is going on in precious metals markets.
Yes, 100%. I love looking at ratio charts, and I was looking recently at the real estate measuring gold. So pretty much real estate is cheaper now measuring gold than it was in 1970s, which is crazy to think because it moved up so much. It's so unaffordable, especially for young people. But if you would convert your productivity in gold, real estate would be as affordable or even more affordable than it used to be, which is very interesting. And sir, what would be some of the factors that you would look at to determine if maybe it's time to get out of gold if you are purely looking at it from investment perspective? So I suppose what I'm asking, how would you know if gold is relatively overvalued in the dollar?
Yeah, you can't know that. And not only that, but I would question the expression investment. It is not an investment, it is money. And it is the ultimate settlement. And that comes down to us from Roman law. It is a fact, all in our common laws. So gold is money, it is not an investment. An investment is something which is in credit. And really, what you're looking at is getting out of credit until credit stabilizes. So I think the answer to your question, when do you get out of gold and back into credit? Basically, you do that when credit is again credibly anchored to the value of gold and not before.
Right, that does make a lot of sense. And if you look at silver, it's, I suppose, in a way, it's still a monetary metal as well, but it also has that industrial side that does play a role. So, how would you view silver at the current price and in the current environment?
Well, um, if I am right and the value of credit continues to decline and we get a crisis, if you like, in the value of credit, then that is going to create demand for not just silver, but other commodities. It's bound to, because their prices will rise measured in declining credit. Silver has this additional factor that traditionally it has been regarded as money. I mean, we were on silver standards going way back, really over the last 2,000 years. In Britain was on a silver standard from the time of the Norman Conquest in 1066. So you can see that this is this is sort of, it's either gold or it's silver. In fact, actually, when the Romans first defined the difference between final settlement and credit, which was 448 BC in the 12 tables, money at that time was a bronze coin weighing one Roman pound. So, these things have shifted. But I think it is true to say that silver is still regarded as a form of money, as it were, um, secondary to gold, very much secondary. The central banks don't buy silver. I mean, certainly not for their reserves. I mean, they may accumulate silver for a sovereign wealth fund, which is a very, very different thing. Um, but what it does mean is that as confidence in fiat currencies declines, then that gold silver ratio should also decline. And I don't think we get back to the level at which Sir Isaac Newton fixed it in the 1700s, which was a ratio of about 15 and a half times. But I can certainly see in these conditions, these currency conditions, as they continue to evolve, I can see the gold silver ratio falling, certainly below 50, probably below 40, and you know, a reasonable expectation that may eventually go down to 30. Because bear in mind that as people awaken to what's going on with the currency, and it's not prices rising, it's the currency falling, more and more people will gradually understand that. And as they understand that, they will get out of currency into silver. And a lot of them will view silver increasingly as a cheap way into gold, which you know, they may say, I can't afford to pay $4,000. I can't afford to pay $5,000 for gold, but I can afford to pay $60 for silver. So you can see that I think in a sense, it's creating its own demand. And this is the sort of good which the more it rises, the less people will sell it and the more people will look to buy it. So it will do the reverse, if you like, of a conventional supply and demand theory, which you see graphically represented in economics classes. So I think this is potentially a very, very different situation.
Yes, and if you look historically, that's exactly what happened almost during every single bull market. We have gold performance first, and then silver does really well near the end of those bull runs because, well, likely because people find it much more difficult to afford gold, and they
Yeah.
move into silver. And Alistair, so will it be more the monetary side or the industrial side that you believe will move silver, will decrease the gold to silver ratio?
I think it'll basically be monetary considerations that do it. I mean, you're right to mention industrial demand, which is really off the scale, particularly with this, climate change stuff and photovoltaic sales and all the rest of it. I think as the price rises, they will probably manage to do with less silver, if you like, in photovoltaic cells. That they will innovate in that sense. But I think also, that story is probably going to decline because as, uh, if you like, as Western economies suffer from a fall in the purchasing power of their currencies, I think it will be seen that policies to do away with fossil fuels are economically destructive and just cannot be afforded. So, in a sense, I would expect industrial demand to decline below where you might think it would be. But I think the difference is going to be taken up by monetary considerations.
Right. And what would be, so you did mention that you like copper and some of the other commodities, but I would like to know how would you allocate capital between the different commodities?
Um, for me, the core holding is gold, simply because this is getting out of credit. This is the way central banks are doing. They're accumulating gold for exactly the same reasons. And every time you see the Bank of China, the People's Bank of China, buying gold, just think it through. They're not buying gold, they're selling dollars. I mean, they're getting out of fiat. It's as simple as that. So that would be very much my core holding. In terms of what might move with it, it's worth noticing that a basket of base metals, um, if you look at that basket's value in gold, it has declined by 80% since the year 1900. And in my Substack research, I produced a chart which showed this effect. Now, if gold is, if that long-term relationship in gold between gold and commodities is true, and yep, it certainly is, then base metals are very much undervalued, and if you like, in fiat currency terms, as well as gold. So that is likely to push up, as that's corrected, is likely to push up base metal prices very, very significantly. So they could actually outperform gold. But since we're looking at at currency risk, fiat currency risk, and that is what you've got to get out of. I would say that running out and buying, say, copper or whatever, if you can do it, um, is a speculative play. Silver is also a speculative play compared with what should be your core interest, which is gold, which is being accumulated by central banks, is owned by central banks, and will continue to be accumulated by central banks, and will form the basis of future monetary stability. We will always return to that. So, really, gold is the core holding. I would say to anyone who is looking to escape out of the current situation, stop thinking like an investor. Just think about preserving your wealth, not accumulating it. And I think that's the key, which everybody should take away from this.
Would you agree with the statement that in general, retail investors in the West are still not that much interested in gold? So still most of the buyings will be savvy investors and let's say the central banks?
Yes, that is undoubtedly true. I think that the retail buyers of gold, um, basically, yeah, they sort of, I think they've been alerted to the declining purchasing power of fiat. They would look at it as monetary inflation, if you like, but it's credit inflation by Bitcoin. I mean, and they see Bitcoin has risen from virtually nothing up to what, $110,000 or whatever it is today, round about that. And I think this has alerted quite a lot of people to the relationship, if you like, between gold and fiat currencies. They have seen gold rise very substantially, certainly this year. And on that basis, they probably regard this as a bull market. They've got to get in and buy it. In other words, they're thinking like investors, which is actually a big, big mistake. But having said that, what we have seen recently, and certainly in the last few weeks, has been almost a global rush into small bullion bars, coins, and so on and so forth. Uh, I mean, the Perth Mint, for example, has run out of everything. They haven't got anything to sell. We've seen queues around the block in places like Thailand and Vietnam and so on and so forth. And in India, and this is an interesting one, in India, the psychology seems to have changed from, well, gold has gone up and it's too expensive to, I better buy some gold before it goes up even more. So this is a sort of short-term, perhaps, sign that it's a bit overdone, um, if you like, because these are inherently weak holders who are now rushing into it. But having said that, the big picture is absolutely clear. And that is that it's not a case of gold going up, silver going up. It's a case of currencies going down. And that's what you've got to keep focused on.
Yes, make total sense. And sir, would you be interested in the mining stocks? Because at the current commodity price, some of the good high quality producers, they're doing really well from the business perspective, from the cash flow, the balance sheets look good. So what's your take on that whole sector?
Well, for investors, again, we're talking investors rather than you know, rather than getting into cash. Um, I think mining stocks could make a lot of sense. You have to do your own research, obviously, but they probably provide a leveraged play on the back of that relationship between gold, silver, and fiat currencies. But it's not a straightforward story because if energy prices start rising, and they have been very, very low recently, if they start rising, then the input costs for a mine are going to rise. And not only that, but the job of a mine manager is to manage cash flow. So higher prices basically means that a mine manager will go for lower grades. I mean, he's bound to. The idea that a rising gold price is going to lead to immense profitability for the mines, I would caution you in thinking that. It's not necessarily true. It's a slightly more complex picture.
Yes, definitely. And I think with the miners at the current levels, though, if the commodity price stays relatively at the current level, there are good opportunities because I feel like some of the investors they believe that the commodity price will go down and therefore they're not getting as involved with the sector. So if the commodity price does stabilize, and if we don't get this huge spike in oil and natural gas, I do feel there is a good opportunity in that sector, for
Yeah.
sure.
Yeah, I'm sure. No, that's absolutely right. And I think the other thing is that generally portfolio exposure is very much angled at, if you like, at other sectors, particularly tech and AI and all the rest of it. And there's very little exposure to the mining sector. And I think that's something when we see the fashion change, I think it'll be very, very much in favor of mines. But having said that, this credit bubble is so extreme that when it bursts, all bets are off. They really are. I mean, you probably have to count up to 10 and watch the thing fall, watch everything fall quite sharply before you say, right, now we've got to reallocate what we've got into mines. I think mines could, they'll get hit by it as well. You also argue that, there are going to be huge, great flows out of markets. For example, if you look at the US equity market, according to the US Treasury, foreign ownership is in excess of $16 trillion. What are they going to do? I mean, when markets turn turtle, you don't sell your own stock, you sell foreign stuff. So I can see that that's going to be a very nasty effect. I mean, you're talking $16 trillion. Obviously, as the market crashes, it's going to be considerably less, but it's going to generate a lot of selling of dollars. Where does it go? Well, as the dollar's sold down, it'll be reflected, I think, in the exchange rate between the dollar and gold.
That's a very, very good point. And if we look at, so gold is having a little pullback right now. Would you be surprised to see gold flat, for, let's say, for the next year?
I would be surprised because I think things are evolving really rather rapidly. It all comes down to the credit bubble. If you can sustain the bubble, then so long as that happens, gold could move sideways. But I mean, what a wonderful opportunity for stackers, for people who actually understand where the risk in the system is, to protect themselves and just accumulate and accumulate and accumulate. Now, having said that, I think anyone who sort of calls a definite top in this market, and says this is where it's going and this is when it's going to turn, I think is, if you like, uh, making a very speculative statement. All I know is that this is the biggest credit bubble in history. And the valuation level between US equities and the long bond, which traditionally should more or less be a perfect inverse relationship, that's become so stretched. I mean, it's more than, I think it's almost three times as stretched as it was during the dot-com bubble, when you had this sort of mania, if you like, of investors, yeah, just having to get in, having to get in. We're not quite at that mania, but we're pretty close to it. And I think that we just have to see the things that could contribute to the instability of this credit bubble. And in that sense, I'm watching Bitcoin, which is a child of the credit bubble. It's as simple as that. The idea that this is a new form of money, forget it. It actually correlates with the Magnificent Seven in the Nasdaq stock index. So we know who holds it. It's exactly the same people. And as the credit bubble undermines tech stocks, you'll see that it'll undermine Bitcoin as well. But Bitcoin is already losing its momentum. So I think this is probably a canary in the coal mine, as it were.
Yes, I think Michael Saylor recently said that he expects Bitcoin to be 500 trillion or
Yeah.
something like
Well,
that.
yeah, I mean, this is the thing. Bitcoin is full of, shysters, Ponzi schemers, crooks, and all the rest of it. I mean, it's a very, very bad thing. It really is. And people should know this. And what Saylor is doing is the equivalent of a Ponzi scheme.
Hmm.
Quite simple.
And so, Alistair, I like to ask this question for the younger audience. So, if we have an individual who's still at the beginning of his and her wealth building path, they have so many options with the crypto sector, the AI, the things that we're discussing. What advice would you have for that individual when they're still quite new? They want to invest, they want to start their wealth building path. But so, what advice would you have so that they don't make too many mistakes and don't get burned?
Well, I would give them the advice that I wish I had when I first went into the stock market. And that is understand that what drives stock values is the availability of credit to drive them. So if banks are going to lend money to people to buy stocks, which is what they've been doing, and this is evident, if you like, it, particularly in the level of margin debt, which is 1.1 trillion. It's over 1.1 trillion now. That was at the end of September. Um, if you understand that, then watch the cycle of credit. That is the way in which you will accumulate a fortune. Don't get beguiled by fashion. That's the
Yeah.
important thing.
Yes, to buy something, you need to have money to do it, and if they're giving you money, that makes total sense.
If the banks aren't lending money to speculate, because this is the other side of it, what happens is that once the credit bubble pops, the banks are going to want their money back. They're going to say, come on, and you'll find that they will be selling stock as collateral, irrespective of anything, because they've got to ensure that they don't end up with bad debts. And it's tough. You'll find that suddenly you're bust very quickly, particularly if you're leveraged.
Yes, definitely. So, Alistair, these are all the questions I had. Is there anything else that you would like to mention that you believe is important that we haven't covered?
I think we've pretty much covered it, actually. The only thing I would say is understand the difference between money and credit. And you can then, once you have that as a starting point, you can then make an assessment as to how to protect your wealth. And as I say, it's coming to a period when you need to protect your wealth rather than try and accumulate more wealth. And if you want more, go to my Substack and you will complete your education.
Yes, I will have all the links in the description below. So, sir, thank you so much for your time. I really enjoyed the conversation, and I hope to have you back on the show.
Thank you very much indeed. Nice to be with you.